You enter into a trade, and immediately it goes the other direction. Come to find out, you have entered in at the worst possible place within the chart. Story of your life, right? I'm going to show you how to objectively identify structure so that this can happen to you far less and you can trade with a lot more clarity. If I told you this was a 1 minute chart, you would probably look at me and say, okay. And if I told you it was a 1 hour chart, you might say the same. This is a daily chart. Lower lows and lower highs is still a downtrend, regardless of what time frame you are on. Because of the fractal nature of markets, there's going to be smaller trends within the larger trend. Now, both are equally as important in my mind, because the smaller trend could be a short-term reversal back up to a level or back down to a level. Let's say you're in a large downtrend, which you can see this market is. But when these highs and these lows are being formed, within the interior of the high and the low that has been created, there's going to be smaller trends. We call these minor trends. Within this minor downtrend that is formed, we actually break a larger major swing level, and then we get a break in structure back up to the upside. So this could be a cause for a short-term reversal down on this time frame or up on this time frame, depending on where you're at. And you might be able to take a trade based off of these signs and these symptoms back up to one of these levels for a short-term reversal. Let's get into the objective rules for identifying swing levels. In a down move, notice that we are making lower lows and lower highs. And then eventually there is a 2-candle pullback that results in this line being drawn right here. All right, so in a downtrend, when I have a 2-candle pullback, specifically after a previous level had been broken, so we would have had to break a previous swing level over here, and then I would have had to get these 2 candles of pullback. The next step is I draw this line. Now remember, these 2 candles do not have to be consecutive. In this example, they are not consecutive, but sometimes they will be. I draw that line. That is step 2. Step 3, I get a solid candle close below that level that has been formed, and that is going to give me step 4. That now allows me to draw my new swing high to identify that we are indeed still in a downtrend, and this is going to be my low, this is going to be my high, and then when that level is broke, you can see the process continues. 1 candle up, 2 candles up, I draw my line. When that level gets broken, I then look, where's the tallest place that they pulled back to? This would be my new high. And then the process will continue over and over again until there's a change of direction. Why would this be important? Well, if I am in a downtrend, but I have a trading setup on the day itself that tells me I should be looking for a long trade, I don't want to counter trend something that is currently still making lower lows and lower highs. So as I am drawing these levels, I am waiting for the market to give me a sign that there might be a change of direction. And on the flip side of that, if I was looking for a short trade and we're still making lower lows and lower highs, and the market starts to pull back in some type of 3 push pattern, that might give me the opportunity to trade the trend continuation on the day. The same rules apply if you're in an uptrend. The market is breaking into new highs. They're making higher highs and higher lows. Step 1, I need a 2-candle pullback. Notice the market has came back down. The candles do not have to be consecutive. I just want to see them pull back in 2 candles or more. They give me that 2-candle pullback. Step 1. Step 2, I draw my line. Then the market breaks that high with a solid candle close. That's step 3. Notice that the body of the candle has confidently broke above that level, and that gives me step 4. I now can draw my low, confirming that we are still in an uptrend. The fractal nature of markets. The idea that everything happening on a higher time frame is happening far more frequently down on a lower time frame. If I were to take this 1 hour uptrend and put a magnification of a lower time frame, this is a 15-minute sort of trend that you can see. You can imagine in this up leg of the 1 hour chart, the 15-minute chart is making a series of swings. And in this 1 hour pullback, the 15-minute chart may appear to go into a downtrend. And then all of a sudden, they will have caught everybody in that pullback, and then it will resume the trend without you, forcing people to short down low before resuming the overall higher time frame trend to the upside. So how do you avoid this? Understanding major and minor trend. If you understand that the market is in a major uptrend, and you take a short, your expectations could be a bit lower. You can have trading setups that repeat over and over again, so that when the setup starts to perform as expected, you can take action. We are not looking to trade direction when you are trading a setup. The market structure is just there to help you and assist you to enter in at an appropriate time, and to also, of course, gauge expectations of how far that move might actually go. If I'm taking a trend trade on the 15-minute chart in a major uptrend, the possibility or the opportunity for range expansion is much higher. Now, if I'm taking a short in a 1-hour pullback based off the 15-minute chart, my expectations might be a bit lower, and I might risk a lot less with that understanding. The difference between a break-in structure and a break-up structure is very simple. A break-in structure could be a leading indicator to a possible trend direction change. A break-up structure is simply a level has been broken as a continuation move of that trend. Now, this applies to both major and minor trend. So if you have a major break-in structure, that is going to hold a lot more weight relative to a minor break-in structure. A minor break-in structure could just lead to a temporary pullback before resuming the overall trend. Regardless of those facts, a break-in structure or break-up structure, the next step is very simple. I am looking for 3 pushes in order to gauge where that pullback might land so that I can enter into the market appropriately. So over here on the left, you can see break-in structure the first time the market makes a counter-directional move. Notice the lower low back down on the inside of this range. They were making higher highs and higher lows, and then they made a lower low. On the flip side of that, this higher high that was formed was a break of structure. That was a higher high to continue an already pre-existing uptrend. I like to think of breaks in structure as the market has become out of whack. So if we're making lower lows and lower highs, and then the market breaks to the high, what does this do? It triggers in breakout traders long. They have guessed the direction correctly, but they have timed this incorrectly. That is why I look for those 3 push pullbacks following one of these breaks of or breaks in structure. Because whenever structure breaks, it triggers more traders into the market who are attempting to trade that breakout, and you can expect some kind of stop hunt or some kind of pullback that follows. So for example, we had that break in structure to the high, right? We made lower lows, lower highs, and then we made that higher high. And then it is my job as the trader, if I'm looking at this as a trading setup opportunity, to gauge 3 pushes back down into the low, read price action in that pullback using the time of day and the candles, of course, to gauge where I should be entering in for that now existing uptrend that could be forming. I'm getting in early on that pullback to resume that uptrend. The same thing can be applied to breaks of structure. So we saw this example a couple slides ago where they made the higher high and then they made a lower low. Notice that once they made that lower low, the trend doesn't just automatically resume. There has to be a process the market goes through to convince people that it's going to go back up before resuming the downtrend. So you can see that here where they made the lower low, and then we have 1 candle of pullback, 2 candles of pullback, and more. We have actually multiple candles of pullback where I could have drawn my low down there, and then they made the entire market basically, or all the traders, believe that, hey, this is going to continue to go higher. But in reality, it was just a pullback to resume that downtrend. So break in structure, lower low, look for 3 pushes to gauge the pullback for the trend continuation. Same thing with breaks of structure, trend continuation. They have broken that level and gone lower. They've pulled back in 2 candles here. I draw my line and I use a system of 3 pushes to gauge where that pullback could end to allow me to look for a sell high opportunity. I don't want to be selling down at the low to try and resume a trend. I want to wait for the pullback to allow me to get in at the best possible fill price. So lower low, 3 pushes back up, and then the trend can finally continue. A bit of a follow-on example. Again, making lower lows and lower highs. They're continuing to break structure down. Lower low, 3 push pullback, trend continuation, lower low, 3 push pullback, trend continuation. Except after they continue the trend, they've made this lower low, then they make a higher high. Market's out of whack. I look for 3 pushes for the potential reversal if that setup is something that I'm looking for. If I'm looking to take a long, well, this is a good indication to start watching this pair, and then I can wait for that 3 push pullback to gauge my entry at a specific time of day within my trading session if it continues to present. So here you can see the higher high, push 1, pause, push 2, pause, push 3, and this is even a nice little W down low, down, up, down, and then the engulfment of the middle structure of that W, which is one of my leading indicators, part of my entry criteria to allow me to get into this market. So what does 3 pushes do? What does the understanding of structure do? It keeps you patient. If you have 2 lines on your screen and you're just waiting for one of them to break, everything on the inside of that becomes consolidation. So you have your levels in place, and you're just waiting for one of them to break so that you can finish your entry criteria. Keeps you patient, allows you to know exactly what you're waiting for. It allows you to spot setups that are forming. After a new extreme is formed, you can expect some kind of 3-push pullback, and like I said, it can help you to time those entries appropriately. Now, regardless of what time frame you're currently trading, this understanding of structure will help you. Now, me personally, I usually look at the 1 hour, the 15-minute, and I use the 1-minute chart as an entry time frame. And a lot of people can say that the 1-minute chart is fast, it is noisy, but the truth is they just don't truly understand or have objective rules of how to identify the structure. Down on the 1-minute chart, the rules still apply regardless of the time frame. So if I have a lower low and a 2-candle pullback, I know that that's my low, and my pre-existing high still exists. If they make another lower low, I now have a new high in place, and when they pull back in 2 candles, I will then have a new low. In this example here, you can see that the 15-minute chart was making higher highs and higher lows, but then it made a lower low. And in the 15-minute chart pullback, again, thinking about the fractal nature of markets, this is going to put the 1-minute chart maybe into an uptrend. But eventually that uptrend will break down on that 1-minute chart, which again will help me to gauge where to get into the market. So over here on the 1-minute, this is kind of a blown up model of what is happening over here in this 15-minute bar and into the new 15-minute bar. You could see that the market had gone into consolidation after making higher highs and higher lows. And then now the 1-minute chart has also broke down. Lower low, I look for 3 pushes. Now I'm down on the 1-minute chart looking for those 3 pushes to look for my entry. We've got a push 1, push 2, push 3, and then a up, down, up, and then engulfment. This is also a bit of a descending triangle and a larger M to allow me to get into the market at the appropriate time. I don't want to be trading short at the break of a level because I could become what is considered the first mouse or the person that has the direction correct, but they have timed the trade wrong. And then they stop hunting against you. They stop you out. It's very frustrating. You start revenge trading. You start doing all these weird things that you wouldn't normally do because you're acting on emotion, and then eventually the trend continues. If you have made it this far into the content, you're obviously enjoying it. Do me a huge favor, hit that like button. If you haven't subscribed to this channel and you're enjoying this content, I post every Saturday, and I have live streams every Tuesday and Thursday at 5 p.m. I do appreciate it. Let's get back into this slide, though, looking at this 15-minute chart of the US dollar Japanese yen. They are making higher highs and higher lows. And notice, this is what I'm talking about. This higher high, notice how they come out of this consolidation in 3 pushes. Now, they have broke a major swing level at this point, which means that my major swing low could be all the way down here. They broke a major swing high, 3 pushes. My major swing low is down here. But notice that the 15-minute chart then starts to go into a downtrend. It starts pulling back. But then eventually, it resumes the uptrend because the 1-hour chart or a higher time frame was dictating that it wanted to continue to go higher. Once they finally make higher highs and higher lows coming out of consolidation, this previous day's high, making higher highs, higher lows, notice that they made that lower low on the 15-minute chart. That being said, my major swing low at this point is all the way down here. That's a lot of space. So on the 15-minute chart, after it made that lower low and starts to pull back, I could get down to the 1-minute chart to gauge and see where I should be entering in. So in this last leg of that 15-minute pullback, this is the 1-minute chart and what it looked like. The 1-minute chart was making higher highs and higher lows, and then all of a sudden, it makes a lower low. And then it pumps back up into the high, pumps back up into the high, pumps back up into the high, makes a lower low, 3 pushes, and that allows you to enter in. Now, in this example here, there was news. Me personally, I do not trade before the news. I believe that is gambling. So I was forced to wait until after the news. But regardless, they made a lower low, once again, break of structure, and gave a nice 3-push pullback and an M, also known as a double top. They've engulfed that M for the entry on the way down. Before I start talking about 3 pushes, I need to tell you what is the definition of consolidation. We've already identified how to identify a high and a low. Everything on the inside of that high and that low becomes consolidation. So if we're making higher highs and higher lows, and then it starts to go into consolidation in between a low and in between a high, that is all consolidation. Then it breaks down, coming out of consolidation, maybe in 3 pushes. Makes a lower low, makes a lower low, and then it makes a higher high. Now we have a break in structure back up to the upside, and it goes back into consolidation between a low and a high. They spike the high, they spike the low, and they pull back into consolidation. This was the early warning sign of a potential reversal. They have came out of consolidation in a 3-push pattern, push 1, push 2, and push 3. They've made a higher high, they've spiked the high, they spiked the low, and there goes the reversal, back up. All right, think of it like this. 3 push patterns is psychological. The market moves the way that it moves because us, human beings, we react a certain way whenever the chart looks a certain way. It makes us commit our money at certain areas of the chart. So in that first push, because humans need to have lots of confirmation, that might get your attention, but you might not actually take action based off that first push. In the second push, however, that is the push that I believe traders have started either buying or selling. And on that third push, you are now selling or buying at the worst possible place of the chart. Why do I tell you this? I tell you this because I am looking for signs and symptoms that I am correct about the 3 push pattern and about where they are catching people trying to either buy up high or sell down low. And once I have that evidence, it will give me even more opportunity or even more reason to take my trade. Here's an example of coming out of consolidation in 3 pushes, which was likely a larger time frame pullback and then resuming that trend after they've completed the pattern. We were in between a high and a low. Notice that they had a low here. They pulled back in 3 candles and then went lower. So they made a lower low, putting this or making this a consolidation. And then they come out of that consolidation, push 1, push 2, push 3 to the high. Now I believe that, hey, people are trapped in push 2 and in push 3 at the worst possible place of the chart. I don't know that for sure, but I'm looking for evidence that I'm correct. Higher high, lower low, a 3 push pullback, and an M to allow me to enter that trade. Now I have confirmation. Now I have the belief that I am correct just looking at the pattern of the trend alone. Now, that being said, at the beginning of this video, I told you that I trade solely based off of setups, not based off of direction. But again, this could be a very great pattern or way of gauging market structure. And if I have a sell high opportunity for the day, and I believe that because of something that happened yesterday or the day before, that my setup should be a sell high opportunity, this might be a good pattern for me to have seen. We're making higher highs and higher lows, pulling back. We make a lower low. They pull back in 3 pushes and give me an opportunity for entry. Fantastic. Another example of how the market comes out of consolidation. Monday for the week is the opening range for the week. Monday's range is a high and a low. So by definition, that is a consolidation. Tuesday comes down and they push outside of that consolidation, push 1, push 2, and push 3. Then they go back into consolidation after completing that pattern. We have 3 pushes outside of consolidation, outside of the opening range for the week. And on Friday, they made a higher high, they spiked the low, they go back into consolidation, and that gives you the opportunity to gauge or find that setup, allowing you to take the reversal off of the low of the week after 3 pushes outside of the opening range, back up towards the low of the opening range, or maybe even just the previous day's high. For those of you who don't have a set in stone process to how you approach the market each day, this is mine personally that I use. Number 1, I'm going to identify a larger setup. If you want to know about these setups, I have a playlist on my channel called Watch in Order for Effective Learning, and it goes over all of these. Step 2, market presentation. The only 2 patterns that I'm looking to trade is a short squeeze or a long squeeze pattern or a parabolic trend trade pattern, basically peak high, peak low, consolidation in the middle for the explosive move. Step 3, I'm going to observe and look at the structure of the market. I'm going to look and see, is the 15-minute chart still trending, or has it broke down and made a lower low or a higher high? Based off of this information, I can get down to the 1-minute chart and look to see if the 15-minute chart starts to pull back. The 1-minute chart will be in a specific trend. Let's say that the 15-minute chart makes a lower low and starts to pull back. That's going to put the 1-minute chart into an uptrend. Then I go down, I look at the 1-minute chart, and I say, okay, this is my entry criteria. Everything else is lining up. Step 1, 2, 3, and 4. Now I need my entry criteria to play out. 1-minute chart needs to have a break in structure. I need to have 3 pushes. I need an M or a W. And then I need an engulfment of that M or that W at a specific time of the day so that I can get my first entry and look for follow-on entries to add in or size in to that trade. This is another beautiful example of a trend trade and also a reversal trade in the same day. So over here, check the times down here. The New York session for me begins at 8 a.m. Eastern time. So at 8 a.m., the market starts to pump up and make higher highs and higher lows, and then it breaks down and makes a lower low. Now, let's say that I had a sell high opportunity for the day or a sell high setup that I believed was going to be a good trade. This might give me the opportunity on the pullback to enter in and trade back down to the low from the previous day. On the flip side of that, if I have a buy low opportunity, some kind of setup that leads me to believe that that could be what I'm looking for, you now have a consolidation in between a high and a low that has came out of that consolidation and push 1, push 2, and push 3 back down into that low from the previous day, and then made a higher high back up on the inside, gives you a 3 push pullback and a W for you to enter into that market. It goes both ways depending on the setup that you're actually looking for, but the most important thing is the structure actually in line with what you're trying to do? If I was trying to go long over here, this doesn't make any sense because we're still making lower lows and lower highs, and I need to wait for the market's early leading indicator, the early warning sign that the market might actually be ready to flip around. I just want to reiterate one last time that I do not look to trade simply based off the direction. I am personally looking for trading setups, and the market structure is just a tool to help me get into the market at the appropriate time. Ladies and gentlemen, I do hope you've enjoyed this video. If you have and it provided any sort of value, let me know down in the comments below. Hit that like button, subscribe if you have not already. You'll enjoy the rest of your day. Bye-bye.